We're going to run this a little bit like a college 101 class. So I'm going to talk. There's going to be an opportunity for questions. This is not you sit there silently and listen. Let's get into it. RWAs and DeFi, why boring is good. So let me start at the very beginning. Why have DeFi at all? Why have crypto assets at all? What makes this stuff interesting? What makes everything interesting is the fact that when an asset is issued on a blockchain, it's better than when an asset is issued in a spreadsheet and through paper contracts and through a lot of human effort. When an asset is issued on a blockchain, you get these superpowers, these DeFi superpowers. These asset superpowers are, and this should be obvious, but these are programmable assets that anyone can add new logic and functionality to. They're autonomous. You can build systems that run 24/7, day and night, regardless of market hours. They're transparent. When an asset's on the blockchain, you can see the entire history of it. You can see how it works. You can see the code of a DeFi protocol. You can understand it. It's efficient in that it just keeps working, and it's fair. Everybody on the blockchain and every asset is treated the exact same way. An asset that has these powers is better than an asset that doesn't have these powers. Now, let's walk through the timeline of DeFi really quickly. So, starting in about 2017, we started to see DeFi primitives. MakerDAO, Compound, Uniswap, Aave, Curve. These things do one thing really well and really simply. And to start with, they did this for DeFi native assets, assets issued natively on a blockchain. A couple years later, we started to see more complex systems. Yearn, Olympus, Fei, Alchemix, Convex. These are DeFi protocols built, in some sense, on other DeFi protocols. And over the last year or so, we've really seen like the massive adoption of staking derivatives, like Lido, Rocket Pool. We're starting to see new complex systems like EigenLayer. But regardless of this, we're seeing an evolution from simple systems to complex and more complex systems. And the assets that are interoperable in these are whatever's available on the blockchain today. Now, you just saw a whole history of DeFi. How much has actually been happening in DeFi, and how active has it been? Well, we saw this massive growth of assets, and since then it's been petering out. Even as we've been building better, more interesting, and more complicated systems, the total amount of assets in DeFi has been basically stagnant. Stagnant really for about almost 2 years now, coming off a much higher peak. This chart should scare everybody in the audience right now, because what this chart says is, if we don't do anything differently, this is going to probably be a similar chart 2 years from now. Now, why did that chart look so scary? Let's start with a very simple problem statement. The DeFi superpowers that I mentioned earlier are only available to assets that are on-chain. And the amount of assets that are on-chain hasn't really been growing. You know, when I founded Compound in 2017, I thought by now, and I told every venture capitalist that would listen, that by 2023, every asset would be on-chain. I thought we were going to have stocks and bonds and currencies and commodities and real estate, and all of those things would be on the blockchain available for DeFi to program, to make better, to make more useful. And over the last couple of years, not that much has come on-chain. We have the same assets that we roughly have had since 2017. There's new tokens, obviously, but for the most part, the list of assets is the same as the list of assets when I got started in crypto. And only crypto-native assets really have these DeFi superpowers. When I look at the world, I see a really, really simple chart. There's about $1.1 trillion of assets that exist on-chain today, and there's about $950 trillion worth of assets that are not on-chain, that are still administered the old-fashioned way, that are put together with spreadsheets and legal contracts and humans and duct tape, and can't really do anything that they don't already do. This massive gap is the opportunity for everyone in this room to think about. DeFi is capable of making that $950 trillion of assets useful and better than it exists today. Not just operating with the $1.1 trillion of assets that exist today. Right now, if you look at any DeFi system, It's really Ether, a couple popular ERC20 tokens, wrapped Bitcoin, stablecoins, and that's it. Every asset on Earth has the opportunity to migrate on-chain and to be interoperable with a DeFi platform. Stocks, bonds, currencies, commodities, real estate, loans, derivatives, you name it. One day it's going to be in DeFi, but today, very little is. Now, there's two paths to real-world assets, or RWA, or whatever you want to call it, that's happening today. The first is actually assets migrating off of the blockchain back to TradFi. So if you look at MakerDAO and areas where there's huge amounts of off-chain to on-chain interaction, it's actually flowing in this blue arrow of deployment. They're taking money from the blockchain and they're investing it off-chain. The other approach, the gold arrow, is the way that I think there's a bigger opportunity to bring that $950 trillion on-chain, and that's tokenization, where you take an asset that doesn't yet exist on-chain and you bring it on-chain. All that means is that the ownership and the rights associated with it get recorded on the blockchain. At a high level, this should be incredibly simple. The first RWAs, in my mind, are the stablecoins. We just heard this incredible presentation by Nick Carter going into great detail about why, but these are the first real-world assets. $1 in a box with a token issued against it. Now, you might ask yourself, why are these the first assets? The answer is because they're the simplest assets to tokenize. It's $1 that has no cash flow associated with it, that sits in a box, and a token is issued against it. There's no governance rights, there's no ownership rights, there's no cash flows. It is boring. I apologize if the text on this one's a little bit small. Now, by looking at what has worked, the most boring dollar in a box, we can start to figure out why we don't have other assets yet. And I just want to go through some of the challenges arising in the process of tokenization. The first is from a KYC, AML, compliance, and tax perspective. Tokenizing an asset that's more than just a simple dollar in a box is hard. When a token is in a pool, it's hard to judge who owns it. Most assets sort of require, whether you like this or not, complex systems of whitelists and blacklists and structures created to say who's allowed to own it in the first place. There's complex securities laws in the US and in every single jurisdiction around the world that apply to almost any asset that you want to tokenize. Just the financials of an asset are complex. If something has a dividend or a stream of payments, it's so much harder to take it and tokenize it. How do you get the cash flow from the asset to the token holders? How do you get the governance rights into the hands of token holders? How do you get the unique characteristics from that asset on-chain? It's incredibly hard. But the most important one actually comes down to demand. There's a lot of demand to hold $1 on-chain. How much demand is there to hold a really esoteric asset on-chain? I've seen a lot of projects that over the last 6 years that have tried to tokenize something really esoteric with a small amount of liquidity and a small market cap and a small pool of people who would be prospective owners. And there's been very limited demand. I'm not going to bash on individual projects, but I will say that demand is the most important thing in terms of tokenization, because demand pulls an asset on-chain, not the other way around. Now, this is the important chart. All of this sums up to be a tokenization framework that I use to predict what is actually going to get tokenized. The first asset to get mainstream tokenization was dollars. And that's because the complexity of dollars is incredibly low and the demand for them is incredibly high. It's a very simple two-dimensional chart. Increasing in complexity, we have things that have complex cash flow or ownership or storage costs or behaviors. Assets with yield, commodities, things that are a little bit more complex than a really boring dollar sitting in a box. But these don't have an equal amount of demand. Right now, everybody is clamoring for yield. Everybody wants that sweet 5.5%. There's not that many people that want a complex commodity. There's a reason why there's 100 different projects out there that are trying to tokenize treasuries or tokenize yield or tokenize assets that actually produce cash flow for their holders. They might be a little bit more complex than $1, but there's also a lot of demand. In the distant future, I think we're going to see a lot of tokenization around equities and real estate. These are much more complex to get right. Transferring them on-chain, getting the characteristics, the behavior of them right, figuring out all of the complexities of them. It's going to happen eventually. It's going to happen when the demand for these assets is greater than the time spent to figure this out. The path to tokenization is not going to be equal. The most boring assets are going to get tokenized first. The most complex are going to get tokenized last. I don't even have on here complex things like derivatives and off-chain assets and like bank loans and all of this stuff that has lots of structuring associated with it. Boring is good because boring makes it easy to bring on-chain. Boring is good because it's easier to interact with a DeFi protocol. Boring is good because it makes it easier to understand. The title of this talk is Why is Boring Good? And it's because boring is what's going to be tokenized first. Now, I want to open this up to Q&A because that's the most fun part, and I saved 4 minutes for you all. Don't feel bashful. Just stand up and ask a question if you have one. Great question. He said, why are equities complex? Why are they hard to tokenize? Well, they're hard to tokenize because an equity comes with a lot of things. It comes with cash flows moving from off the blockchain onto the blockchain when a company has a dividend, whether that's owning an equity directly or owning it in a fund. It has a complex tax structure. It has complex governance rights. Whether you want to vote your share of stock or not, it has a whole additional value to the holder that's not simply the ownership of it. And to make governance work, you might have to have a complex system that takes information from the blockchain off-chain. There have been some really exciting governance experiments in crypto over the last couple of years with voting and recording votes and tokenization. In my prior life at Compound, I got to actually do a lot of governance stuff. But until you figure out exactly how to combine the off-chain and on-chain characteristics of an equity, it's hard to tokenize. Anyone else? Cash is the most boring. Yes, what else is boring? Well, cash is the most boring. Treasuries are a little bit less boring, but still pretty boring. Corporate bonds are pretty boring. And I actually think what's boring, but not too boring, is actually foreign currency. So one of the things we haven't seen at all is non-US dollars that are tokenized. There's a huge opportunity for non-dollar stablecoins or non-dollar tokens. We haven't seen it play out yet because it's a little bit less boring than dollars. And it's a little bit more complex. But I do think at some point we're going to see a massive adoption of non-dollar stablecoins, especially internationally. Guys, speak up.
Yeah. I think you have a bunch of slides talking about compliance as anti-money laundering. Why is it important for the RWA?
All right, great question. There was a couple of slides talking about compliance. Why is compliance important for RWAs? So the basics of this is anytime you're taking an asset from the real world, and that's the RW and the RWA, it already has an existing legal structure. It already has a structure in which it's operating within a jurisdiction with rules for how it was created in the first place. It doesn't exist in a vacuum. A crypto-native asset that's issued on a blockchain for the first time has very little systems built around it. Any system that exists off-chain already exists within a very large system of who's allowed to interact with it, why, when, how, who already owns it, what is the regulatory process for it. And in order to bring it on-chain, there's going to be a lot of existing stakeholders that care. It's not like an asset that's crypto-native that's issued on-chain for the first time out of the void. Pretty much any real-world asset is existing very specifically not in the void. It's existing with a built-up infrastructure around it already. And so in order to bring it on-chain, you're going to have to figure out how to navigate all of the existing ownership and stakeholders that participate in those assets. We have time for one last question. All the way at the end. Oh, this is a great question. The best question of the day is, how can you get real-world assets or assets that are tokenized to be interoperable with DeFi? Because right now, every single DeFi system that's been built has basically been built on the assumption that every asset is freely transferable and freely holdable. Certain assets like USD Coin or Tether might have a blacklist function, but it doesn't really impact the DeFi protocols. In order for DeFi to scale, DeFi protocols are actually going to have to start to build out a structure where they understand what assets are completely permissionless and which assets have permissions associated with them. But I think they'll coexist under one roof. Thank you, everybody.